Something unusual is happening in the crypto market right now. $222 million is flowing into Bitcoin ETFs, while at the same time, Ethereum is seeing $75 million leave the market. Now on the surface, that might just look like normal rotation, but when you zoom out, this could actually be one of the clearest signals we've seen this cycle. And almost nobody is talking about what it means. Same market, same window, opposite directions. That is not noise, that is a signal. And staying until the end of this video is going to matter, because the full picture of what this means only becomes clear when you connect every dot. So stay with me. Nothing in this video constitutes financial advice. All data referenced is for informational and educational purposes only. Cryptocurrency markets are highly volatile. Always conduct your own research before making any investment decision. Before we go any further, drop a comment right now. Where are you watching from? Is it early morning coffee time for you, or are you catching this late at night? I genuinely want to know who is in this community right now, because the wealth continuum is built for people who want to think differently about money. And you are exactly who I'm building this for. Now let me give you the exact numbers we're working with today, because precision matters, and I'm not going to be vague with you. According to SoSo Value data, United States listed spot Bitcoin ETFs pulled in $223.21 million on April the 23rd, 2026, extending what is now an 8-day consecutive inflow streak. Over those 8 days, the total capital that has entered Bitcoin ETFs is $2.1 billion. That is not a misprint. $2.1 billion in 8 trading sessions. And this is happening while Bitcoin is trading around $78,000, having briefly touched $79,477 earlier this week, its highest level since late January. Meanwhile, on the exact same day that Bitcoin ETFs absorbed $223 million, spot Ethereum ETFs recorded net outflows of $75.9 million. That outflow snapped what had been a 10-day streak of positive inflows for Ethereum. 10 days of building momentum, erased in a single session. Now, here is the question I want to plant in your mind right from the start, and I want you to hold on to it as we go through this whole video. Why would two assets in the same market on the same day with the same macro backdrop move in completely opposite directions from an institutional flow perspective? The question has an answer, and the answer changes how you should be thinking about this cycle. Stay with me, because we're going to get there. But first, I need to show you something about the scale of what Bitcoin is doing right now, because let's put $223 million in context. According to data from 24/7 Wall Street, Bitcoin ETFs pulled in $335 million on April the 22nd, the single biggest daily inflow of this entire month. Then on April the 23rd, they pulled in another $223 million. The cumulative April total now sits at approximately $2.4 billion, nearly double what Bitcoin ETFs brought in during all of March, which was $1.32 billion. And here is the number that should genuinely stop you. Since their launch, U.S. spot Bitcoin ETFs have now accumulated $58 billion in total cumulative net inflows and hold $102 billion in total assets. They currently hold over 1.3 million Bitcoin across all funds, worth roughly $103 billion. Let that sit for a moment. Over 1.3 million Bitcoin held inside regulated ETF structures. Now, let's talk about who is doing the buying, because this is where it gets interesting. BlackRock's iShares Bitcoin Trust, the ticker IBIT, is responsible for roughly 73 to 75% of recent inflows. On April the 23rd alone, IBIT brought in $167.49 million of the total $223 million. The fund now holds 809,870 Bitcoin, representing 62% of all assets held across U.S. spot Bitcoin ETFs. To put IBIT in perspective, Bloomberg intelligence analyst Eric Balchunas stated that IBIT's $3 billion in recent flows puts it in the top 1% of all ETFs. Not just crypto ETFs, all ETFs, every single category. And there's a newer player now entering the conversation. The Morgan Stanley Bitcoin Trust, which launched on April the 8th, 2026, has already contributed $95 million during this current inflow stretch without recording a single day of outflows, with total inflows since launch reaching $163 million. Now here is what I want you to understand about this type of capital, and this is something that most retail observers miss entirely. When a pension fund or an asset manager or a wealth allocator buys into a Bitcoin ETF, they are not placing a short-term trade, they are making a structural allocation decision. These are the same institutions that hold their equity positions for quarters or years at a time. The money that goes into IBIT through a registered investment advisor is not going to panic sell at the next 2% correction. Eric Balchunas confirmed this week that Bitcoin ETF flows have now turned positive across every rolling time frame he tracks. 1 day, 1 week, 1 month, 3 months, and year to date. That level of consistency across every single measured period is what institutional analysts call a regime change in flows. It doesn't happen often. When it does, it matters. But stay with me, because the Bitcoin side of this story is only half of what we need to understand. The Ethereum side is where the real tension lives. Before I get to Ethereum, I have a question for you, and I genuinely want you to type your answer in the comments. When you look at $2.1 billion flowing into Bitcoin ETFs over 8 days, does that make you more confident about this market? Or does it make you nervous that institutions are positioning ahead of something you can't see yet? Because both of those reactions are reasonable, and I'll tell you exactly why in just a moment. But first, well, what's the weather like where you're watching from today? Is it the kind of Friday afternoon where you can sit back and think clearly about your portfolio? Or are you grabbing 5 minutes wherever you can find them? Because this video is going to reward your full attention. There are things later in this script that I promise you have not thought through yet. Stay with me. Now let's talk about Ethereum, because Ethereum's situation right now is genuinely more complicated than most people are making it out to be, and the complexity is actually important. Here is the current state of play as of April the 24th, 2026. Ethereum is trading at approximately $2,331 to $2,400, depending on the session. It opened Friday down approximately 1.9% from Thursday's opening price of $2,376. Bitcoin's market cap sits at roughly $1.33 trillion. Ethereum's market cap sits at approximately $233 billion, a significant gap. Now, the $75.9 million outflow from Ethereum ETFs on April the 23rd broke a 10-day inflow streak. And according to reporting from MEXC and Dusty BC crypto data, BlackRock clients alone accounted for roughly $21 million of that selling pressure. The stated reason for the shift? Risk appetite weakened after disappointing earnings from major technology firms, specifically IBM in this case. When large cap tech missed expectations, professional traders reduced leveraged exposure across risk assets, and Ethereum got caught in that rotation. Now here is where I need you to think carefully, because two things can be simultaneously true, and they often are in crypto markets. On one hand, Ethereum's on-chain fundamentals are showing signs of something significant. According to Glassnode data, 1.4 million ETH left exchanges in the last 30 days, the largest surge of exchange outflows in 7 months. When coins leave exchanges and move into cold storage, immediate sell pressure reduces. That is structurally constructive. Bitmine Immersion Technologies staked over $170 million worth of Ethereum within 24 hours this week. The firm disclosed it holds a treasury of 4.98 million ETH, worth roughly $11.5 billion, including 101,627 ETH purchased last week, the largest single-week accumulation of ETH by any corporate entity in 2026. Weekly DApp revenue on the Ethereum network has dropped to $13 million in April, 50% below where it was 6 months ago. That is a meaningful decline in network utilization from retail users. The Ether futures basis rate, which measures demand for leveraged long positions, has dropped to around 1%, far below what analysts consider the neutral threshold. This tells you that derivatives traders are not excited about Ethereum right now. They are cautious. So you have massive corporate accumulation happening at the same time as retail engagement falling off. You have institutional ETF outflows happening while on-chain supply is tightening. You have smart money doing one thing while the price action tells a different story. Does that remind you of any other period in Ethereum's history? It should, and I'll come back to that. Let me now show you the third piece of this puzzle, because the Bitcoin and Ethereum flow data only makes complete sense when you look at what's happening to Bitcoin's market dominance. As of this week, Bitcoin dominance has broken out to 60.66%, according to data from BIDGET Research. This is significant because it represents the first clean breakout from the 58 to 60% range that it held for almost 8 months, from roughly August 2025 through April 2026. The Altcoin Season Index, the metric that measures whether altcoins are outperforming Bitcoin on a rolling 90-day basis, sits at 37 out of 100 as of April the 24th. An alt season is only confirmed above 75. At 37, the market is solidly in Bitcoin dominance territory, and that index has been sitting near multi-month lows. Now, let me give you the historical context here, because this is the part that viewers at this point in the video understand, and late viewers who leave early miss entirely. Bitcoin dominance has touched the 60% to 66% zone 3 times in the past, in 2018 and in 2021. Each time it reached this zone, it either broke through and kept climbing, or it was rejected, and capital rotated massively into altcoins. Analysts watching the technical structure are now pointing to 66% as the next target, which would represent a multi-year cycle high. And here is the thing about ETF-driven dominance that makes this cycle different from 2018 or 2021. In past cycles, when Bitcoin dominance was rising, it was rising on speculative momentum. Retail was buying Bitcoin, then rotating into Ethereum, then rotating into altcoins. The whole thing was driven by the same pool of retail liquidity moving between assets. That is not what is happening right now. Right now, Bitcoin dominance is rising because institutional capital coming from outside the crypto ecosystem is entering specifically and exclusively through Bitcoin ETF vehicles. These are pension funds and asset managers who have been authorized to access Bitcoin but may not yet have been authorized to access Ethereum or altcoins. They are not rotating out of Ethereum into Bitcoin. They are coming from outside, from traditional finance, into Bitcoin as their first crypto allocation. That distinction changes everything about how you interpret the dominance number. Think about it this way. When new money enters a market and it goes entirely into one asset, the dominance of that asset rises not because the other assets are losing, but because the total market is growing and the growth is concentrated in one place. Are you starting to see the picture? Because there's one more layer to this. Stay with me. I want to ask you something that I genuinely don't know the answer to, and I'm curious what this community thinks. If you hold Ethereum right now, are you holding it because of its fundamentals, because of its technology, or because you expect the price to go up? And do you think those are all the same reason or three different reasons? Type your answer. I read every comment on this channel. And one more thing. Where are you in your crypto journey right now? Are you just starting to understand how ETF flows work? Or have you been tracking this data for years? Because the answer changes what I want to emphasize in the second half of this video. Let me know. Now here is the part of this conversation that most finance channels on YouTube will not have with you, because it requires holding two contradictory ideas in your head at the same time. The ETF outflow from Ethereum is real. The institutional hesitation around Ethereum relative to Bitcoin is real. Bitcoin's narrative as the premier institutional crypto asset is real and it is growing. And at the same time, the corporate accumulation of Ethereum is accelerating. The on-chain supply tightening is real. The upcoming Glamsterdam network upgrade, which is targeted for the first half of 2026 and aims to raise gas limits toward and beyond 100 million per block while implementing parallel transaction processing, is real. The next upgrade after that, Hegata, planned for the second half of 2026, which begins the transition to post-quantum security, is real. So what does that mean? It means you're watching two completely different time horizons operating simultaneously. Institutional ETF flows operate on a short to medium-term risk management horizon. When tech earnings disappoint, risk-off positioning kicks in, and Ethereum, which is still treated as a risk-on asset relative to Bitcoin, gets the outflow. But the corporate treasuries buying and staking Ethereum are operating on a multi-year horizon. Bitmine isn't staking $170 million worth of ETH because they expect it to perform in the next 30 days. They're staking it because staking generates a yield, and they believe the underlying asset will be worth substantially more over a 3 to 5 year window. These are not the same trade, and yet retail observers conflate them because they look at the same price chart. Here is the historical parallel worth examining. In early 2023, Ethereum sat between approximately $1,200 and $1,600. ETF-style institutional flows were non-existent. Ethereum was treated almost entirely as a retail speculation vehicle, and yet, during that window, large on-chain accumulation was quietly building. The supply was tightening on exchanges. Developer activity was at cycle highs. Anyone watching only price or only ETF flows in early 2023 missed what happened next. The macro environment today is different. The institutional landscape is different. The regulatory structure is different. But the pattern of divergence between on-chain behavior and surface-level flow data has appeared before. And it is worth asking the question. Which brings me to the most important part of this entire video. Stay with me. We are nearly there, and the conclusion is going to reframe everything we've discussed. There is a macro backdrop to all of this that has not been mentioned once in the mainstream coverage of these flow numbers, and I think it is the most important context of all. Bitcoin is up approximately 14.3% in April alone, according to CoinGlass data, on track to be its strongest month since November 2024. The broader crypto total market cap sits at approximately $2.68 trillion. And here is what is happening in the background. Bitcoin is showing a 62% correlation with the S&P 500. It has also been moving in near perfect opposition to the US dollar index. The dollar weakened roughly 0.5% when the Israel-Lebanon ceasefire extension was confirmed this week. And Bitcoin benefited from that weakness in a way that increasingly resembles gold's behavior during currency debasement cycles. Sharp question. If Bitcoin is behaving more and more like a macro hedge against dollar weakness, and the dollar is being structurally pressured by US debt dynamics, What does that mean for institutional demand from sovereign wealth funds and central banks who are just beginning to look at Bitcoin as a reserve asset? Senator Cynthia Lummis this week endorsed Admiral Paparo's push for Bitcoin proof of work in U.S. cyber defense and urged Congress to pass the Clarity Act. Galaxy Research noted this week that Strategy's 815,061 BTC could potentially overtake Satoshi's estimated stack by late 2026. This is no longer a story about retail speculation. It is a story about asset class legitimacy at the sovereign level. And that changes the entire demand curve for Bitcoin over the next 3 to 5 years in a way that a single week of ETF flow data cannot fully capture. If you've been watching the Wealth Continuum for any length of time, you know that we don't chase price and we don't make moon predictions. We build frameworks, mental models that help you make better decisions under uncertainty. Here's the framework that applies directly to everything we've discussed today. There are 3 layers of money operating in this market simultaneously. The first is fast institutional money, capital that flows in and out of ETFs weekly based on earnings, macro data, and risk sentiment. This drove the $223 million Bitcoin ETF inflow and the $75.9 million Ethereum ETF outflow on April the 23rd. The second is slow institutional money, the kind that takes months to allocate, buys through OTC desks, and holds for years. This is what Bitmine represents with its 4.98 million ETH treasury. This is what IBIT represents as it absorbs over 809,000 Bitcoin into long-term custodial structures. The third is structural demand, the kind that comes from sovereign recognition, regulatory clarity, and financial system integration. This layer is still arriving. It is not fully priced into Bitcoin yet. It is not priced into Ethereum at all. The question you should be asking yourself is, which layer of capital are you positioned to benefit from? If you don't have a clear answer, that is probably the most useful thing this video has given you. Not a price target, not a hot take. A question worth thinking through seriously. Let me leave you with 2 questions that I want this community to wrestle with. The first is this. Given everything we've covered today, the 2.1 billion in Bitcoin ETF inflows, the dominance breakout to 60.66%, the Ethereum on-chain tightening happening simultaneously with ETF outflows, do you believe we are in the early stages of a structural bifurcation in the crypto market, where Bitcoin gets institutionalized and becomes its own permanent asset class, while Ethereum becomes something else entirely? Or do you think this is a temporary gap that closes when Ethereum-specific catalysts arrive? The second question is harder. If you are holding crypto right now, is your allocation based on a framework, a genuine understanding of which type of money you are trying to participate in, or is it based on what felt right when you last checked the price? Because how you answer that second question matters more than any price chart. That is what the Wealth Continuum is about. Not tips, not targets. Thinking clearly about money. If this video gave you a framework worth keeping, hit subscribe, because we put out content on this channel that is built for people who want to understand wealth at a structural level, not just ride the wave and hope for the best. Every video we make on this channel is designed to give you a model, not a moment, a system, not a signal. And if you want to keep watching, the next video on this channel is going to go deeper into the macro forces that are driving institutional Bitcoin adoption right now. The sovereign angle, the dollar correlation angle, the things that don't fit inside a tweet, but that determine where this market is actually heading. I'll see you in the next one.